Okay, so you want to own a crypto mining farm. Buy some computers, point them at the Bitcoin network, and let them solve math problems all day while the coins roll in. Free money, generated out of electricity and arithmetic. No customers to please, no inventory to move, no employees calling in sick. Just machines, running in the dark, turning power into profit. That is the pitch. That is more or less what a mining farm does. The problem is what it actually costs to run one. What happens when two numbers move against you at the same time, and why some of the largest, best-funded mining companies on Earth have watched billion-dollar operations collapse into bankruptcy in the space of a single bad year. So let's start with what you're actually buying. A crypto mining farm is not a vault full of computers quietly minting coins. It's closer to a factory, except the raw material is electricity, and the product is a chance. Specifically, a chance at winning a reward that the entire network is competing for, every 10 minutes, forever. The machines you buy are called ASICs, short for Application-Specific Integrated Circuits, and they do exactly one job: guess numbers as fast as possible until one of them happens to satisfy a mathematical condition set by the Bitcoin protocol. Win that race, and you and everyone in your mining pool split a reward. Right now, that reward is 3.125 Bitcoin per block, a number that used to be twice as large until an event called the halving cut it down in April of 2024. That single event, a scheduled, unstoppable rule written into the protocol itself, cut every miner's revenue in half overnight, with no warning beyond the calendar. And it will happen again. In 2028, the reward drops again to a little over 1.5 Bitcoin. You are not buying a business with predictable growth. You are buying a business that gets mechanically less profitable on a schedule you cannot negotiate with. Here's the part almost nobody explains properly. Winning that race isn't about being clever. It's about brute force, and brute force costs electricity. A single modern mining machine, one of the efficient ones, draws somewhere around 3.5 kilowatts of power, running 24 hours a day, 7 days a week, never sleeping, never taking a break. Multiply that by a farm with hundreds or thousands of units, and you are looking at a facility that consumes power on the scale of a small town. And that power bill doesn't pause when Bitcoin's price drops. It doesn't pause when your machines are old and inefficient. It runs, constantly, whether you're making money or bleeding it. These machines also don't just consume power quietly. They're loud, somewhere in the range of 75 to 85 decibels, comparable to standing next to a running vacuum cleaner, except it never turns off. And they throw off enormous amounts of heat, which is exactly why serious mining operations don't set up shop near cities or customers at all. They go looking for the opposite: stranded natural gas that would otherwise be flared and wasted, surplus hydroelectric power in remote river valleys, excess nuclear capacity running overnight when demand is low. A mining farm is one of the only businesses on Earth that actively wants to be as far from people as possible, chasing cheap, abundant, otherwise wasted electricity wherever it can find it, because that electricity is the entire product. So before you make a single dollar, you need to survive two separate purchases. First, the hardware. A single top-tier machine today runs somewhere between $4.5 and nearly $10,000, depending on how efficient it is. And efficiency here isn't a nice-to-have. It's the entire game. There's a number engineers use called joules per terahash, which is just a fancy way of measuring how much energy a machine burns to produce a unit of computing power. Lower is better. The newest machines sit around 13 to 15 joules per terahash. Machines from just a few years ago, the ones still running in plenty of warehouses because nobody wanted to write off the sunk cost, burn twice that or more. That gap matters enormously because it means two farms can be doing the exact same job, competing for the exact same reward, and one of them is burning double the electricity to get there. In this business, that's not a rounding error. That's the difference between profit and slow bankruptcy. Second, you need the electricity contract. And this is where the entire fantasy either survives or dies on contact with reality. Industrial hosting rates, the kind serious mining operations negotiate directly with power providers, currently sit around 7 to 8 cents per kilowatt hour. At that rate, with modern hardware, mining can be genuinely profitable, even in a rough market. But residential electricity, the kind most people actually pay at home, runs 16 to 20 cents per kilowatt hour in a lot of the country. At that rate, running the exact same machine, You are very likely operating at a loss every single day, and the machine doesn't care. It keeps drawing power, keeps generating heat, keeps costing you money whether or not the math works out in your favor. Do this at scale, and the math becomes brutal. Industrial miners today are spending somewhere between $32,000 and $55,000 in hosting and power costs just to produce one single Bitcoin. If Bitcoin is trading above that number, you're making money. If it drops below, you are mining coins that cost you more to create than they're worth the moment they land in your wallet. And here's something most people getting into this never fully grasp until it's too late. You almost never win that race alone. A single machine, even a brand new, top-of-the-line one, has such a tiny fraction of the total computing power on the network that trying to solve a block by yourself is closer to buying one lottery ticket while millions of other tickets are being bought at the exact same time, every 10 minutes, forever. The realistic odds of a single machine finding a block solo are close enough to zero that almost nobody does it. Instead, farms join mining pools, combining their hashing power with thousands of other operations around the world. When the pool wins, the reward gets split proportionally, based on how much computing power each participant contributed. It turns an unpredictable, rare jackpot into small, steady, predictable payouts. But that convenience isn't free. Pools charge a fee, usually somewhere between 1% and 4% of your revenue, taken directly off the top, on every single payout, forever. It's a small number until you're running it across a fleet of 1,000 machines for years at a time. And that right there is the trap that has swallowed some of the biggest names in this industry. Because you don't control the two variables that decide whether any of this works. You don't control Bitcoin's price, and you don't control network difficulty, which is a constantly adjusting measure of how hard it is to win that race, rising automatically as more machines around the world join in. You only control your electricity rate, your hardware efficiency, and how long you can keep the lights on while you wait for conditions to turn back in your favor. And that waiting game is where fortunes have been lost. Let's talk about what happens when it goes wrong, because this isn't hypothetical. It has already happened, publicly, spectacularly, to companies that were supposed to be the smart money in this industry. Core Scientific was one of the largest publicly traded Bitcoin mining companies in North America, operating data centers packed with specialized machines across 5 different states. In July of 2021, the company was valued at $4.3 billion. By the end of 2022, the day before it filed for bankruptcy, that valuation had collapsed to $78 million. Not a decline, a near total wipeout, in under a year and a half. What happened? 2 things happened at once, which is exactly the trap this business sets for you. Bitcoin's price collapsed through 2022, cutting mining revenue, and energy prices rose at the same time, cutting into margins from the other direction. Revenue falling, costs rising, at the exact same moment, on a business that runs 24 hours a day, regardless of which direction is winning. Then a third problem landed on top. Celsius Network, a crypto lender that was also one of Core Scientific's customers, filed for its own bankruptcy in the middle of 2022. When Celsius's debts got wiped out in its own bankruptcy proceedings, that put direct strain on Core's balance sheet, because money Core was owed simply stopped coming. This is the part people miss about crypto mining. It doesn't fail in isolation. It's tightly wired into the rest of the crypto industry. And when one piece falls, the strain travels through contracts, through hosting deals, through customer relationships, and lands on companies that had nothing to do with the original collapse. Core wasn't alone. In September of 2022, Compute North, a company that provided hosting infrastructure for other miners, filed for Chapter 11 as well. Marathon Digital Holdings, another major public miner, reported $80 million of exposure to Compute North's collapse. $80 million gone or at serious risk simply because their hosting partner went under. And Greenidge Generation, a miner that actually owned its own power plant, supposedly one of the more insulated setups in the industry, still reported net losses stacking up past $100 million in a single quarter that year. Owning your own power source was supposed to be the safe move. It wasn't safe enough. By December 21, 2022, Core Scientific filed for Chapter 11 bankruptcy protection in Texas. And here's the detail that tells you everything about how this business actually works. Even while filing for bankruptcy, the company kept mining. It didn't shut down the machines. It kept running them because the operation itself was still cash flow positive, on a debt-free basis, according to its own statements. The machines were still profitable. It was the debt, the the leverage, the financing that had been used to build the empire in the first place that brought the company down. That's a distinction worth sitting with. The mining itself wasn't necessarily the failure. The bet on how fast to grow and how much borrowed money to grow with was the failure. Now, fast forward. Core Scientific spent months working through bankruptcy court, targeting a reorganization by September of 2023, restructuring its debt, cutting deals with creditors. The company survived. It came out the other side, smaller, restructured, chastened. But plenty of others in that same wave didn't make it back at all. And here's what should really get your attention. This isn't a story from the distant past. It's not ancient history you're safely looking back on from a position of hindsight. The exact same pressure is building again, right now. Bitcoin hit an all-time high of $126,198 back in October of 2025. As of this year, it's been trading down in the $58,000 to $63,000 range, a drawdown of well over 50% from that peak. June alone saw the price fall roughly 20%. And in the first quarter of this year, public Bitcoin mining companies sold off more than 32,000 Bitcoin in a single quarter, the largest institutional miner sell-off ever recorded. Why would profitable miners sell off their own product in bulk? Because hash price, the actual daily revenue miners earn per unit of computing power, fell below break-even for a meaningful chunk of the industry. When your product costs more to make than it's worth, you sell what you've already made just to keep the lights on, literally and financially. So who's actually surviving this? It comes down to the same handful of variables, over and over. Electricity cost below roughly 7 to 8 cents per kilowatt hour. Hardware running under 15 joules per terahash. The newest, most efficient machines available. And uptime, meaning the machines are actually running, not sitting broken waiting weeks for a repair while still costing money in space, insurance, and opportunity cost. Miss any one of those three conditions, and the business tips from a machine that mints money into a machine that quietly burns it, 1 kilowatt hour at a time, whether you're watching or not. There's a phrase serious operators use, the shutdown price. It's the exact threshold where running a machine stops making economic sense, where the electricity cost to keep it on exceeds what it can possibly earn. Below that price, every hour the machine runs is a loss. Even if the meter is still spinning, even if the fans are still humming, even if the dashboard still shows coins accumulating. In 2026, some of the least efficient hardware categories on the network are generating value at a level barely above the cost of the electricity they consume, which means a huge portion of the global mining industry is operating right at the edge of that shutdown price, right now, as this bear market grinds on. Every difficulty adjustment, every 2 weeks, either eases that pressure slightly as inefficient miners drop offline, or tightens it further if Bitcoin's price keeps sliding while difficulty holds steady. It's a knife's edge, recalculated every 14 days, whether anyone in the industry is paying attention or not. Now, there's an argument on the other side of this, and it's worth taking seriously, because not everyone in the industry sees this moment as doom. The optimist's case goes like this. Every time a wave of inefficient miners gets forced offline because they can't cover their power costs, network difficulty eventually eases in response, and the machines that survive inherit a bigger slice of a smaller, less crowded pie. Bear markets, in this view, aren't a threat to the strongest operators. They're a cleansing event that quietly hands market share to whoever was disciplined enough to have cheap power and modern hardware locked in before the storm hit. There are operators running sub-7-cent electricity with the newest machines who are still comfortably profitable through all of this, even with Bitcoin down 50% from its highs. The skeptics push back hard on that framing. Their argument is that this business has no real moat at all. Anyone with enough capital and a cheap power contract can enter. The product you're mining is a pure commodity, indistinguishable from every other miner's output, and the 2028 halving is going to cut revenue in half again, with absolutely no guarantee that hardware efficiency or Bitcoin's price will rise fast enough to cover the gap. Both sides are looking at the exact same numbers. They just disagree on whether surviving a bloodbath is a competitive advantage or just a delay of the inevitable. And this is where the fantasy really breaks down from the reality. The dream is passive income. Turn on the machines, walk away, watch the coins accumulate. The reality is that this is one of the most actively managed, most operationally intensive businesses you could possibly get into. You are negotiating power contracts. You are managing hardware failures, and there are a lot of them. because these machines run at full load, generating serious heat 24 hours a day in industrial environments, and control boards fail, fans die, power supplies burn out. A broken machine produces zero revenue while it still depreciates, still needs a repair slot, still occupies floor space you're paying for. Some operators wait 4 to 12 weeks for external repairs on failed units, which on a large fleet means a meaningful chunk of your hardware could be sitting dark at any given moment, silently eating into your margins while doing absolutely nothing. The operators who handle this well build their own in-house repair capability, cutting that turnaround down to a week or two instead of a month or 3, because every day a machine sits broken is a day you're still paying for the floor space, the insurance, and the electrical capacity reserved for a machine producing nothing at all. It's the same math as an empty storefront in a shopping mall. The rent, the security, the maintenance, none of it pauses just because the thing that's supposed to be generating revenue has gone quiet. And you're managing all of this while having zero control over the two forces that decide whether any of it was worth doing. Bitcoin's price, which can move 20% in a single month, as it just did, and network difficulty, which only ever ratchets upward as more competitors around the world plug in more efficient hardware, permanently raising the bar for everyone already in the game. Every single competitor who upgrades to a more efficient machine makes your older machine relatively worse, even if you haven't changed anything about your own operation at all. That's a business where standing still is functionally the same as falling behind. So if you do decide to build or buy into a crypto mining farm, understand exactly what you are buying. You are not buying a machine that prints money. You are buying a continuously running industrial operation with razor-thin, constantly shifting margins, competing in a global race where the rules change automatically every 2 weeks and the reward gets cut in half on a schedule you cannot negotiate. You are betting, simultaneously, on your ability to secure cheap power, your ability to keep buying the newest hardware before it becomes obsolete, and on the price of an asset that dropped 50% from its peak in under a year. Core Scientific had 5 state-of-the-art facilities and a $4 billion valuation, and it still nearly lost everything, because it bet on growth financed with debt, in a business with no room for that kind of leverage when 2 variables turn against you at once. The machines were fine the entire time. The bet on top of the machines wasn't. The real business here was never the mining rig sitting in the warehouse. It was managing the gap between what electricity costs you and what the network will pay you for solving a puzzle nobody outside this industry could even explain. Get that gap right, with cheap power, efficient hardware, and the discipline not to over-leverage on the way up. And it can be one of the more durable positions in this entire space. Get it wrong, and the machines keep running, keep drawing power, keep costing you money, all the way down. Because that's the part the dream never mentions. The computers don't know if you're winning or losing. They don't slow down when the price falls, and they don't speed up when it rises. They just run, hour after hour, converting electricity into a chance, indifferent to whether that chance is currently worth anything at all. Whether that indifference works for you or against you was decided long before the machines were ever switched on. It was decided the moment you signed the power contract.